All right, cool. Hello, everyone, and thank you for joining this Real Estate Roundtable. I forget which week this is. This has got to be like week number 10 or 6. That's it?
Six, 7.
Yeah, and I'm having too much fun because I think it's like 10 or 12, man. 6, that's it? Holy moly.
6 or 7.
All right, well, in this Real Estate Roundtable, we got a lot to cover, right? I mean, first-time home buyers, we try to pick topics for the Real Estate Roundtable that everybody can conversate in or be a part of the conversation. That's what Blab is all about. And I'm trying something new. I'm live streaming this on YouTube as well. So hopefully maybe we'll get some interaction there as well. But at any rate, we've got a lot to cover. I'm Jason Bates, a host of a podcast called Valley of the Sun Real Estate Show right here in Phoenix, Arizona. You can check that out by visiting my website at www.valleyofthesunrealestateshow.com. And Jorge, my trusty compadre, how you doing, man?
What's up, man? It's good to see you again this week. And I like this topic. I like the whole topic of first-time home buyers because it's I think it's a topic that's important, but it definitely gets overplayed a lot in the real estate circles. You know, like sometimes people like focus too much on it, I think, at times. But it's again, the last 3 topics I find fascinating. It's definitely good stuff to talk about.
And I may have a crowdfunding. I've got a gentleman who crowdfunding. So I think that'll be a topic in the future. Hopefully, if I can convince him to be on the Blab with us on a Real Estate Roundtable, that's a pretty hot topic going on right now.
Yeah.
So, but let's get right into this because we're gonna. I want to cover from beginning to end. I think we're entering here in Phoenix anyway. We're entering into our buying season.
Yeah.
It really starts after Super Bowl, really lasts through, mid-June. That really dictates the rest of the year, if you will, for real estate sales here. Because after that, it's just so blazing hot. Kind of becomes our winter, if you will.
Right.
So when a first-time home buyer, first-time home buyers, there's some definitions of first-time home buyer that maybe are a little confusing. A first-time home buyer is considered, at least on the mortgage side, for most mortgage lenders, anybody who has not owned a home in the past 3 years, which in today's world is probably quite a few people considering they had short sales, foreclosures, whatever in their past.
So they would consider, so if I bought a house 10 years ago, and actually, this is my situation. I bought a house 10 years ago. I got deployed, and I actually sold it while I was deployed, and then so since then, when I came back, I have not bought another house since then. So I have purchased a home, and now I live with Jeannie and stuff. So and we're not planning on moving, so I haven't had to buy anything. But if I bought a home 10 years ago and I owned it for 7. 6 or 7, whatever. So with that, if I went to go, which I am going to be back in the market again next year, when I go buy a house next year, I would be considered a first-time home buyer.
If you have not owned any property in the past 3 years, you are considered a home buyer.
Jesus, well, that doesn't make any sense.
Well, but the market has changed, right? I mean, what happened in 2008 when you purchased a home or whenever you purchase it's much different now. Documentation,
right,
the requirements, all that. I mean, it is kind of different.
Yeah, but so when we hear the stats about first-time home buyers, like there's a lot of stats out there that you'll see on the financial websites and news stations and stuff like that, and business stations. They're talking about first-time home buyers and whether the purchases are going up or down or whatever. Is that then standard kind of across the board whenever those numbers are being reported? Then it's if they have not owned a house in the last 3 years and then come back into the market, they're first-time home buyers.
That is correct. As long as the loan officers, now this is part of the deal that doesn't always have the best of integrity. Mm-hmm. As long as the loan officer is marking the application correctly. Okay. Now that's a big if. Right. Okay. But yes, first-time home buyers, and that's all for down payment assistance programs, any other kind of specialty programs that are out there, have not owned a home the past 3 years.
Right.
You're considered a first-time home buyer.
Wow.
So that's the definition of a first-time home buyer from a lender's perspective. From a consumer's perspective, hey, I owned a home in 10 years. I'm a second-time home buyer. I get that, but for lending purposes, it's in the past 3 years.
Oh, okay.
So, I want to give some tips here. I want to give some tips that I don't think a lot of consumers follow. They tend to put the cart before the horse here a little bit, in the sense that they look for the house first, the mortgage second. Which I've always said. I've said it here on this blab and on some videos and other things that I've done. The sexy part about real estate is the house. That's the sexy part, and everybody wants to get to the sexy part first. But the down and dirty stuff is, exposing yourself to your credit, which a lot of people feel they may be judged or something like that based on their credit. We put such a high emphasis on credit scores and things like that in our society that, I think people get a little gun shy about doing the credit. They want to first find the house and then go for the credit after that.
Right.
And to which then they get into trouble, because then they'll do just about anything to get into the house because they're so emotionally tied to that house, which is a big mistake for first-time home buyers.
Well,
and so you try to avoid that.
Right. But again, I'm still kind of stuck on the 3-year thing, but I could totally see that for if it truly was someone's first time buying a house, and it's their, especially when it's your first time, it's all the more special, all the more stressful and everything else. You really, once you decide that you want to buy your first home and you truly are a first time home buyer, like you've never bought one before, it's always a decision, but more intensified. It's like obviously me and you have never had a kid before, but or gave birth to a kid before, but I think it's the same thing like what the women say too, is like, that first time they get childbirth is and then it gets easier after that. And I think that's the same thing that happens with purchasing a home. That first time you do purchase it, you are willing to do just about anything to make that happen.
Right.
That's very emotional.
Yeah, you are. And there's a lot of unexpected things. And even still today, I mean, as I said before, when you purchased a home, 10, 15 years ago, the expectation, if you could fog a mirror, that was kind of the big joke. You could get a mortgage. Today's world, it's not going to happen. I mean, I talk to clients all the time and they're like, well, I didn't have to do that when I purchased my first home, 10 years ago. Okay, well, call your politician and thank them. I mean, I'm just the messenger here. The rules have changed. And that's not to say that, you need to purchase a home every 3 years to stay current with what's happening in the market. But yeah, it's a much different world out there. So, but let's kind of move on from that. Hopefully you got that now, Jorge. You're killing me, brother. First time home buyer. So the first thing I always tell people, how much are you comfortable in paying? And a lot of people, I think, as far as rent goes, they equate the rent to the mortgage. And there's a lot of other things that go into that mortgage, such as your property taxes and homeowners insurance and HOAs if you have them. And even maybe maintenance costs. You may even throw in maintenance costs on a home that you may not have as a renter. So when you talk about affordability, you got to factor in some of these other factors when purchasing a home that you don't necessarily have as a renter. And so affordability is a big, big deal. And calculating out what your affordability is the first step that I always tell somebody, and then kind of work it backwards. In other words, don't go look for a house that's $200,000 and then have payment shock when you hear the payment associated with that $200,000 mortgage. First, find out what a payment is that you are comfortable with, and then work it backwards to what that equates to in affordability as far as a price range goes. That's my suggestion on a first-time home buyer. That way, you don't have the wrong expectation going on there.
Absolutely. You should absolutely work it backwards because, like you said, there's a lot of other expenses tied to it other than just the mortgage payment itself. I think, and depending on what state you're in, some states like our state here in Illinois, we have, it's in the Chicagoland area, we have really, really high property taxes. And they're not just in affluent and middle-class neighborhoods. We're talking like even some of the worst suburbs and cities within the Chicagoland area have just as high taxes as some of the most affluent areas when you're comparing house to house. So calculating that tax bill and all those other expenses and working backwards like that is absolutely such a smart strategy.
Yeah. And taxes vary from city to city, from district to district. So, getting a sense, obviously a lot of people know kind of where they want to live based on schools, based on family, maybe in the area, that sort of thing. So you kind of got an idea as far as that goes, but working that payment out. And I'll make mention here too, real quick, is it's not necessarily how much you qualify for in a mortgage, but how much you can afford, because a lot of people end up being surprised that they actually qualify for more payment than what they actually are comfortable with in paying.
Right.
Especially first-time home buyers, right? First-time home buyers are already kind of puckered up a little bit, afraid of overcommitment into a mortgage, even though they may be paying that in rent already. Just the thought of having a mortgage and a 30-year commitment to a mortgage can be overwhelming. And so having what you can afford versus what you actually qualify for are two different things. So I always tell first-time home buyers when I'm speaking to them, how much are you comfortable in paying each month?
Right.
And then kind of go from there.
Right. No, I think that's solid advice. I like that. It's simple, and that's the way it should be. But I think when you're a first-time home buyer, one of the things that you have to watch out for is the mortgage brokers and the agents, because they do have some of them have funny ways of trying to get you to buy more than you could afford, and like there's a big difference between what you can afford and what you want to actually realistically be paying. Because sometimes that extra $200, $300 a month, that makes the difference between making you living like, paycheck to paycheck and being able to put away a couple bucks for reserves and stuff like that.
Now, another thing too, to take in consideration when you're purchasing is gathering all your documentation, right? You're going to need pay stubs. You're going to need to verify your income. So if you're self-employed or whatever, you're going to need to be able to verify the income. This isn't, hey, I just got a raise. How much do I qualify for? There are different factors involved in that process.
Is there new?
So,
what's going on with self-employed people now with getting a loan? Just if you could shorten skinny it up.
Self-employed, you need a 2-year history of showing self-employment. If you have a 2-year history of self-employment, they're going to average the 2-year. And it's what you claim to the IRS that you make. Mm-hmm. It's not what it's not what you're making currently, or you just got some big I don't want to say promotion, but you got some big contract or something like that, and it's going to pay you X amount of dollars over the next 5 years.
Right.
No, it's what's happened in the past. And that is something that is a little bit of I hate it, man. I'll be honest with you. I don't like it at all, because you're being judged for what you were doing 2 years ago versus where you're at today. Right. Yet you're trying to buy a house today, not 2 years ago. And so that,
that's it. And in my situation, that's exactly it. Because when I started speaking and stopped selling real estate, that's exactly where I was. Those first 2 years, a couple of years ago, especially the first year, there was no money coming in. I knew there was no money coming in. So there's like this big thing, and so that's like the whole thing. And I think every business owner, that first year or two, you're in that startup phase, and you're not claiming a lot, and you're not earning a lot.
You're not earning a lot.
Yeah, exactly. And the thought process behind that for self-employed borrowers is that most companies fail within the first 2 years.
Right.
And so they want to see that you have a viable company that's going to survive the ups and downs of your business.
Right. So, but basically, so it's 2 years, and they're going to look at what you claim to the IRS. They're not going to look at your bank. They're not really concerned with your bank statements coming into the bank or that major contract you just won 2 months ago.
Or gross receipts.
Right.
They're not going to look at that. They're going to look at the net after deductions. Now, some deductions you can add back in, such as depreciation or depletion and things like that.
Right.
Now, if you have an S corporation or you have 1065s or something like that, and you have a partnership, whatever that net is of the company, if you own more than 25% of that company, they're going to want to see the business tax returns to see that the business is viable and operating in good standings, and there's enough money in there for inventory or whatever it is that you your business is all about.
Mm-hmm.
And then they're only going to give you the gross profit of the business. They're only going to give you your portion of that business. So if you own 35% of that business and that business grossed $1 million, well, then you get credit for $350,000.
Right.
You own 35% of that. So, and that generally carries over to the personal tax returns for the most part.
No, it's good.
So
it's good. And obviously with first-time home buyers, especially ones that never purchased a home before, there obviously there's much more self-employed entrepreneurs out there today, I think, than there was even 10 years ago.
Yeah, it's a big one. That's a segment of the population that kind of got pushed aside, right? I mean, from the downturn, the liar loans and all that kind of stuff, bank statement, those loans are making a comeback, but they do require big down payments, high FICO scores, high net worth, a lot of assets in the bank, that sort of thing. So they are out there. They're pretty risky on the lending side, and they're priced accordingly. So you're not going to get the best rate on that type of loan. So if you're, and somebody who has a lot of assets typically and has good FICOs, but can't show the income, a lot of them get upset that they're not getting the best rate. And so, just be prepared that you're not going to get, the best rate that the market will provide if you have the risk factor of not being able to show income.
Right.
Just the way that's just the way it's going to work, I suppose. So now the second thing, once you get all your income documentation together, you're going to want to talk to a licensed loan officer. And I can't stress this enough because this is vitally important. There are a lot of loan officers out there, and loan officers got a lot of bad reputation, or I don't know, bad juju juice, or whatever what adjective you want to throw at it. But there were a lot of shady loan officers out there from 2008. Most of loan officers that are out there today are pretty good for the most part. I mean, a lot of the bad seeds have been weeded out. But when I say that, there are loan officers who work for banks, the big four banks, or your credit union or something like that. And then there are loan officers who actually work for mortgage bankers. And mortgage bankers are mortgage companies that aren't depository banks. The only product they offer is a mortgage. They don't offer CDs. They're not part of the FDIC. They just offer mortgages. They're real specialized, if you will. Now, those mortgage bankers tend to have more flexibility in their guidelines because they don't have other facets of the business that hold them back from being a little more aggressive when it comes to lending and being more open-minded to maybe your situation. Now, if you're vanilla cookie cutter kind of deal, a bank isn't a bad way to go, but the service isn't very good. And it's important to note here that when you're a first-time home buyer, service is everything, in my opinion. You've already got anxiety. You've already got different emotions going through your mind. You want some reassurance. You want to know that you're actually getting into a situation that you can handle. And sometimes hearing it from a third party can give you that reassurance. A bank's not going to provide any type of service for you. I don't care what they say. My son works for a bank. So I used to work for a bank. The banks just don't provide service. You're a number to the bank, period.
What would you tell a first-time home buyer then? If I had to break it down really simple in terms of, I get what you're saying there, but it still is kind of confusing. The difference between a mortgage officer at a bank and a mortgage officer at a a mortgage brokerage, which is not technically not a bank, right? Like your brokerage is a brokerage. Your brokerage is a company that, with like a lot of mortgage brokers, they procure the loans. They put the loans together, right? And then, but you're not part of Fifth Third. You're not part of Bank of America or Wells Fargo or anything like that. And then you'll take that, put that loan together. And then what happens? What should that first time home buyer know about working with a broker compared to a physical bank? Is there risk associated there with it? Can it possibly be less risky? Is it less risky? And then with the service, does the service continue after the loan? Once the closing happens and you're starting to you're starting to write checks, mortgage checks, Like does that make a difference?
Yeah. You've got about 5 different things going on there. So yes, the mortgage banker is, like I said, somebody who specializes in mortgages specifically. Now, the difference between a mortgage banker and a mortgage broker. A broker is a third-party service that gets the loan, solicits you for business, whatever, makes the loan under the underwriting guidelines of whoever they're going to sell it to.
Okay.
So they have no participation in the back end of the mortgage whatsoever. In a lot of cases, they don't even fund their own money. They don't have any warehouse lines. There's no capital involved. They're very, I don't want to say the lower end, but they're very inexpensive. There's not a lot of overhead with them, which is actually something that HUD and Fannie Mae, Freddie Mac dislike 100%. They don't like brokers at all because it just lends itself for the opportunity for fraud.
Interesting.
Because the companies can shut down overnight and reopen under a different name and continue doing business. So, for example, if somebody were to, create, fictitious pay stubs in order to get a loan closed, or fictitious W-2s, they get caught, they get shut down, they open up under a different name, they continue on as if nothing ever happened. There's no liability to them. Now, there are buybacks and things like that from whoever they're selling it to. And with the licensing that we have now, the lenders are actually starting to, wherever the brokers are selling the loans to, are actually starting to attach negative comments and not accepting loans from individual loan officers who are caught doing those sort of fraudulent things. So in other words, if I'm selling a loan to, say, U.S. Bank, for example, and they don't like, or my loan doesn't perform, I didn't use prudent underwriting, I didn't educate the borrower on their options, whatever the case may be, U.S. Home or U.S. Bank can actually say, hey, we're not accepting any more loans from Jason Bates and this license number. I don't care where he works. We're just not going to accept any loans because he's not doing the industry any favors.
Okay.
And so lenders are starting to attach individual loan officers for the performance of their loans. Now, brokers, because they have low overhead, tend to have higher margins. And so a lot of loan officers, if you will, like the brokering aspect of it because they have low overhead and they keep more money. And so they don't close as many loans, but they make more money doing it. So there's that business side of it for the brokers.
What are you guys exactly? Are you guys more?
We are a banker, seller, servicer, provider, which means that's the next tier up. So we service our own loans, which means we have to have more capital in the game, which Fannie Mae likes. And we sell directly to Fannie Freddie.
Okay.
So we do not sell our loans off. We sell some of the jumbo stuff off, some of the HARP loans off, some of the higher risk loans off, just because we don't want all of our eggs in jumbo loans. That's a lot of money invested in one person, for example. But your Fannie, Freddie, HUD, VA, even USDA to an extent, we service those and they'd be making payments directly to us.
Okay.
Now, that's a good point to make here because as a first-time home buyer, in my opinion, you want to talk to somebody who has the full gamut of the process. So in other words, if they have problems with their payments or they have issues with their statements or whatever, the customer can call me directly rather than their loan being sold off 3 or 4 times and getting confused, later on down the road.
Okay. It's
a big service aspect. And HUD really likes that because we do have more money invested. It's kind of like lending your own money. If you gave me $100 and I lent it to somebody, I probably wouldn't use the same scrutiny as if I were lending my own $100 to that same person. I would ask more questions. And so,
I'm sorry to cut you off, but I find this fascinating because I actually didn't know a lot of the intricacies of what, between a mortgage banker and a mortgage broker. And on the realtor side, a lot of times you'll, let me ask you this in terms of like getting deals done. A lot of mortgage brokers or bankers will say that they handle their own underwriting. And
Yeah.
they usually will say that to realtors and to buyers, meaning that like we got some more control over the process because we're like handling more bank stuff here at our office, so we can
Yeah.
make a decision quicker or make a better decision quicker and stuff like that. How does that kind of play into it? Because like it sounds to me like if you can, working with a mortgage banker has a lot more advantages, especially in terms of service level. They have some skin in the game, and that sort of thing, as opposed to the mortgage broker, which there's nothing wrong with the mortgage broker per se, but they don't have as much risk. They're just putting the deals together, and they move on to the next deal. You're not writing your mortgage check to those guys every month. Whereas like the mortgage,
let's talk about like we all have short-term memories, right? So we're kind of like wide receivers here on the football field, because it wasn't that long ago that people closed on their home only not to get their keys because the company that was going to fund the loan went under and could not afford to fund their mortgage. That happened here in Arizona quite a lot in 2008. In Florida, California, same thing. And that was a lot of mortgage brokers. They submitted the file to the bank that they was going to service the loan or buy the loan from them. And the company said, hey, we're cutting ties. We're done. Sorry. And the mortgage brokers are like, well, wait a minute. You already underwrote this file. You already approved it. They signed yesterday. Like, hey, sorry. Too bad. So sad. Take a hike. And, you had a lot of upset consumers at that point. As a mortgage banker, because we have control of our own warehouse lines, and we have all companies have warehouse lines. The warehouse lines have restrictions, overlays on them. They don't want bad loans put on the warehouse line, and you only have about 7 to 14 days for that loan to be on the warehouse line and then off the warehouse line, and then securitized with Fannie, Freddie, sold off, whatever. It's a very short-term loan. And we pay high interest on those warehouse lines. It's kind of like a big credit card. Yeah. So we may have a warehouse line with, say, Deutsche Bank that may be at 14% interest or something. And I'm exaggerating there, of course, but it might only be like $5 million. But we'll roll that $5 million every single month, so that $5 million becomes $15 million for the month. And then we may have another warehouse line that we put VA loans on, and that might be a $7 million warehouse line. And we'll roll that to create a $14 million warehouse line. All companies have those warehouse lines. Those warehouse lines can dictate to the mortgage bankers and brokers, if they have a warehouse line, what type of loans go on there. They don't want loans that maybe are below 640 credit score, right? Because they have a difficult time of getting them off the warehouse line, finding the right investor to buy that loan, and it may exceed that 14-day window of it coming off that warehouse line.
Right. So the mortgage banker then is going to make those decisions on their end a little bit more cautiously than as opposed to the mortgage broker, which it sounds like the mortgage broker, they're writing up loans up to a prescription where they know what they can sell. They know that it has to be this credit score, it has to be this in terms of like the borrower and their finances. It has to meet this criteria, or else they know they can't sell it. So then they know that they can't do that deal, or they should know.
Well, it's a little misleading, right? So when they say, "Hey, we have in-house underwriting, we have this," you have in-house, you have an underwriter that sits in your office that underwrites to somebody else's guidelines. Okay. So it's not really in-house underwriting. You've got a subcontracted underwriter for Wells Fargo Bank sitting in your office. That's what you have, and so that's where it's a little misleading. Yeah, you have in-house underwriting, but they're underwriting to somebody else's guidelines. Okay. So when you have a mortgage banker, seller, servicer provider, such as myself and a few other companies throughout the country, and this is becoming more and more popular. And before I finish that thought, I want to go back a little bit, because back in 2005, mortgage brokering, that was the deal. Everybody was a mortgage broker. Not too many people were mortgage bankers because there really wasn't a need to be a mortgage banker. And if we think back at 2005, one of the big advantages back then was on the HUD settlement statement. When you closed on your home, you had to disclose yield spread and some other fees as a mortgage broker. As a mortgage banker, you did not have to disclose those things because they are considered to be SRP instead of YSP. Now, SRP is service release premium. We're releasing the servicing rights of that loan, and they pay us a premium to do that as a mortgage banker. As a mortgage broker, it's yield spread premium, YSP, and that is what the bank pays the broker to send them the business. Okay, so so it's a little bit different. So SRP, we didn't have to disclose that because we were a mortgage banker and we were subject to SRP rules and regulations. And so you didn't have to disclose that on a HUD settlement statement, whereas a broker, you do. And even to this day, you have to show that on that yield spread premium. And I be honest with you, I haven't done a broker deal in so long. With the new TRID rules that came out in October, I'm not even sure that those even show up on the new TRID rules. Because brokering is kind of a dying thing. There are a few of them out there. They're generally just a couple guys, gals together working out of their house with low overhead and just close a couple deals, and they just have it kind of streamlined.
Yeah.
They have a couple referral partners and that's it. And they have very limited products, very vanilla, and just kind of easy peasy, kind of slam dunk kind of stuff, if you will.
How would I be able to differentiate between a mortgage banker and broker? Does the mortgage broker legally have to call themselves a mortgage broker? Can they still call themselves a mortgage banker?
You can look up their license. You can look up their license through the NMLS and see how they're attached. Here's the sad part: is that most, even when I talk to loan officers today, they don't even know what the heck they are. They say they're a mortgage banker, but they're really a glorified broker.
Yeah.
They have a banking license, but they don't service anything, and they sell every single penny off.
Okay.
So it's a glorified broker. And they say, oh, we have in-house underwriting. You have subcontracting and underwriting in-house. That's what you have. You don't have anything in-house. You don't have any money in the game. Yeah, you have to have certain, $500,000 in reserves to even offer FHA loans for your clients and stuff like that. And you maybe have some warehouse restrictions and things like that as far as capital that's required to operate the warehouse line. But you're really not, you're a glorified broker. And so a lot of loan officers that I speak to, even to this day, say, yeah, I'm a mortgage banker. And it's like, okay, what company do you work for? And I just know through doing this for so long, over 23 years, I kind of know who the players are here in Phoenix. And so I know who's a banker, who's a broker, who's a true player, who's in it for the long haul. And this is why I've said for so many years, I think the mortgage brokers and even mortgage bankers are a dying breed, and I think they will go to the wayside. And that's why we're seeing a lot more mortgage bankers trying to self-service their own loans. Because the real money in mortgages is the servicing portfolio. That's the asset of the company. It's not the employees. It's not your software systems. It's not in the mortgage world. It's your portfolio.
Right.
How well is it paying? How well is it performing?
Yeah.
And so a lot of companies are moving to that platform, trying to build up their servicing platform so that they can raise more capital and do more things. Because the more capital you have, then Fannie Mae, Freddie Mac releases some of the overlays that they have, because they say, hey, you can do this, Home in 5 or some other kind of down payment assistance program if you had more capital. Because if you're going to do that, it's on my phone. If you're going to do that, then we need to have X amount in reserves in case something goes wrong. And so the way to raise capital is to build up your portfolio and show that it's performing, show that you're doing a good job, show that you're using prudent underwriting, show everybody that, hey, we're doing things the right way.
No, it's like I said, there's a lot of inside baseball information there, but it is very interesting and stuff, because it just goes to show you that it is complex on the back end between who you're getting your mortgage from, whether it's a mortgage broker, mortgage banker, or a bank.
I know. And so now getting back, because we probably went off way too deep there, right? But for first-time home buyers, you interview your loan officer. Okay, you have the right to interview your loan officer. Ask them the questions. Are you a mortgage banker or mortgage broker? Ask them to explain what mortgage banking, mortgage brokering means and what it means to you as a consumer. How does it relate to me? Is my loan going to be sold off? Can I make payments to you? What's going to happen with my loan? And and shop it around. I mean, even on our loan estimates and things like that, it is actually encouraged by the government and should be encouraged by everybody. Shop the deal and ask them questions like, how long does it take to close a loan? What are the pitfalls in lending me money? What do you see? What can you foresee some of the issues that you may have with my profile? Ask these questions about yourself because it's going to set the expectation that then you can manage. Too many times I see homeowners or first-time home buyers go to the property, call the yard sign, say, okay, I want to look at this house. You get into the house, you look at it, and then, okay, do you have somebody that can refer me for a loan? And then they talk to that person, and then okay, that sounds good to me, and then they're done. And they don't really interview either the realtor or the loan officer. And I can't stress that enough. Ask the questions. I mean, if you're going to a doctor, you wouldn't go to a lung specialist if you had heart disease. Right. So
let's dive into that because I think it's another good point we can make here. And that is when you're let's say the buyer now, first-time buyer, is going to go out there, take your advice, and go start interviewing, and checking out different mortgage brokers and bankers and whatnot. And one of the first things is they're going to want to find out, can I get qualified with you or not? We don't want the first-time home buyer to go and get pre-approved from 3 or 4 different guys all at the same time, right? Or is there a credit score? Can you damage your credit score if you're getting pre-approved by a bunch of different guys so that you give them all your information, or should you be giving them all your information to have them pre-approve you during the interview process, or how far should that first-time home buyer go? I mean, that's the right question.
Yeah. So good question. So, your credit score does not change. Credit score, let me back up for a minute. Credit score is all about interpretation of risk. Everybody has different interpretations of risk. So, ABC Mortgage Company may have a different interpretation than XYZ Mortgage Company. And so credit scores can vary based on that, number one. Number two, you have the right as a consumer to shop to get the best deal. And your credit score is not affected. Now, if you have your credit pulled like 50 times, and I'm exaggerating, of course, but numerous times in a short period of time, yes, it's going to adversely affect your credit score, because if I'm the last person who's pulled your credit, I have no way of knowing if the first person who's pulled your credit actually extended credit to you. And so there's some inherited risk there in being that last person who's pulled your credit. Now, with that being said, if you have your credit pulled, say, by 3 or 4 different people, no, it should not adversely affect your credit. However, your credit score may vary depending on that company's interpretation of risk. Okay, so like if I pull credit and I get a 640 credit score, somebody else pulls credit, they get a 641. Another person pulls it, they get a 635. And then they say, oh, I had my credit pulled 3 times, that's why I went down. Not necessarily, because that third person at 635 may just may feel that you're a little more risky. Maybe you have too much revolving debt. Maybe you're maxed out on revolving debt. Different variations within the credit profile can determine that score. Okay. They're all going to be very, very similar. But, for example, the mortgage broker may be very conservative on their credit score because they know they have to sell that loan off. And so they're going to take a more conservative approach on the credit score to ensure, because a lot of times the person they're selling the loan off to will also pull credit. The final, lender, if you will, to make sure there's no fraudulent stuff, no whiteouts or anything like that on the credit report that the broker provides the lender. So they'll pull their own credit report and compare that against the broker. And they may not have the same filters on the broker, so they actually may end up with a higher credit score. So it's all about interpretation of risk. Don't let the thought of losing a couple points prevent you from shopping to get the best deal. Right. So if you get a good deal out the gate, then you can shop that online too, right? I mean, you can say, okay, my rate, you quoted me 4%. You can get on a lot of websites. Not all of them are accurate all the time, right? Some of them tell you what you want to hear. Like Lending Tree is a big stick in the mud about I used to be on LendingTree when that first came out back in like 90, was it 99 or something like that when LendingTree first came out. Right. And a lot, the deal then is I'll just offer this person a ridiculously low rate in the hopes that they call me, and I'll let them know that the rates changed, because rates change daily, even hourly. And I'll just sell them the fact that the rate changed, rather than being accurate with what the rates are at the current time that they quote the rate through LendingTree. So LendingTree isn't always ethical. I guess the people who use it's only as good as the people inputting the information. So sometimes you get these things that are way out of left field that just aren't accurate. But you can shop online. Right. This is my point. You can shop to see that you're getting a fair deal.
And okay, let's dive into that, because that's probably one of the biggest things is, how do you know if you're getting a deal or not? Because we should be talking about interest rates and also fees and points that you're paying up front, or added to the loan or whatever. Do you want to get into that a little bit? How do you identify?
So a good rule of thumb on fees. Total fees. Now fees are broken down a couple different ways. There's reoccurring closing costs and non-reoccurring closing costs. Reoccurring closing costs are fees like homeowners insurance, taxes, interest. Those are reoccurring even after you become a homeowner. Therefore, hence reoccurring closing costs. And there are costs that are associated with setting up escrow accounts, which are your taxes and insurance and stuff like that, that are paid up front. And then there are true loan costs, such as underwriting, processing fees, maybe points to buy down a rate, origination fees, that sort of thing. And all those are kind of lumped into the term origination, because it's the cost of originating the loan. You have to underwrite, you have to process the loan, that sort of thing. So, but a good rule of thumb, at least here in Arizona, and I can't speak for the rest of the country, but here in Arizona, a good rule of thumb with all fees combined is about 3% in closing costs. Now, on more expensive homes, anything above $250,000 and more, that might drop down to like 2.5%. On a $100,000 loan, it might be 4% in total closing costs. So that's a good rule of thumb, is about 3%, maybe a little bit less, depending on your loan size. If it's $500,000, it might be 1.75%. It's not going to cost $30,000 to close, on a loan. Cost that. So, but on average, it's about 3% if you're in the average price point.
That's kind of what you're estimating for, going into the transaction, going into the home buying process, is estimating out those closing costs, origination costs. What do you call them? Closing costs, origination costs? What's the right term?
They're closing costs. Yeah, closing costs, really. And that's why a lot of contracts you see have 3% seller concessions to cover those closing costs, right? So that's a good rule of thumb. It doesn't always cover them all, but it's a good rule of thumb. FHA actually allows for up to 6% seller concessions. Not many people utilize that, and not many sellers want to give that up, but they actually offer more than just 3%. But you don't want to offend the sellers all the time with, hey, give me 6%. That was a big deal when the FHA 2-1 buy down was there, because it would cost a couple points to buy down the rate. Therefore, you'd qualify for more home with a lower rate. And then every year it would incrementally go up 1% a year for the next 3 years. So you could actually buy more home when rates were higher. You could actually afford to buy more home by getting into an FHA 2-1 buy down. The seller pays 6% towards your closing costs. You use 2% of that to buy down the rate. And then you have the rest for closing costs.
Right.
So that was the whole purpose of the 2-1 buy down. It's not so popular anymore, because now they've changed that rule to where you have to qualify at the end rate, not the start rate. And so you're actually qualifying for a higher rate than what you had to before. So they kind of went bye-bye. Those type of, back in 2005, right? 6%. Yeah. See, Kenny used it back in 2005. It worked great. So, but so that's kind of the there's a lot to it. And that's why you need a professional, right? I mean, you need somebody who has the experience, and that's why you need to interview this person. when it comes to the mortgage, because that's the foundation of the whole thing. The house is the easy part in a lot of cases, not always, but you're going to be stuck with that payment certainly for the next however many years. And so you want to make sure that you're comfortable and you're making the right decision on that. And the other thing too, I will tell you, a lot of consumers don't ask, is that my only option? A loan officer may pitch to them, hey, this FHA loan is the way you need to go. Or they say, hey, this is what you qualify for in an FHA loan. Ask the loan officer, well, is there any other programs that I qualify for? Could I go conventional financing? Conventional financing is a much better long-term deal. 100%. If you listen to Dave Ramsey, Susie Orman, or any of those big financial planners, they all tell you, go conventional if you can. The FHA has some costs associated with it that you can't get back. The FHA upfront funding fee, which is 1.75%, that's a cost. It's financed into the loan. Consumer doesn't really see it, but it is a cost.
Is that why? Why we're seeing like so many 5%, like 5% down conventional,
yeah, and actually on a conventional loan, you can actually put as little as 3% down on a conventional loan.
And we're seeing
not many people know that.
Right. I'm seeing those a lot more, and then a lot of times is it and like I said, you're going to be able to explain this actually much better than I am. But the difference between the FHA is like you've got these upfront costs that you're going to be paying for, and then when you pay for them upfront, sometimes is it possible to like get to do a conventional loan at like a higher rate? Is it like a and I might be saying this wrong, but I was with a mortgage broker the other day, and he was telling me how he could what he would do to save his clients money on loans is sometimes he could sometimes it would maybe the interest rate might be higher, but they're paying less in fees and origination costs up front. So in the long term of the loan, they're actually paying less money. Are you following me there? Am I off? Or
yeah. That guy's it's a little misleading. I guess it depends, right? So here's you have options as a first time home buyer. So closing costs can be paid by either the seller or the lender, and in some cases even the realtor can contribute toward your closing costs. If the lender contributes to your closing costs, then they typically will charge you a higher interest rate and then take the yield spread premium and use that to pay your closing costs on your behalf. The closing costs are still there. It's just who's paying it.
Right.
Now you get a higher interest rate for that. And depending on your sales price and all that kind of stuff, the payment difference might be, $25, let's say. And that $25 amortized over the life of the loan, it may take, if you get, for $25, you may get $3,000 in return, paid for by the lender to pay your closing costs. So you take the $3,000 divided by 25 and you get 60 months to recoup that cost, right? So you basically took out a $3,000 loan for 60 months is essentially what you did. Okay. And if you sell the home within 5 years, and the average right now is 4 to 6 years that people either refinance or sell their home. And so if you sell it within that period of time, then you gotta factor that cost in, right? You determine yourself if it fits your budget. If you're going to keep the loan 30 years and never touch it, then you go for the best rate. Period. I mean, that's the best deal long term because you're not going to pay as much interest over the life of the loan. So that's of my opinion there.
It just depends on, do you actually really think you're going to stay in the home for that long?
And that's a hard one, right? That's a hard one to kind of, I will say this. I've seen a big shift in our country in the attitude toward real estate. It's more of a buy and hold right now. Most people, at least here in Phoenix, I'm even seeing this trend right now. I bought my house, to give you a little personal story. I bought my house in 2011, got a really good deal on my home.
Yeah, I bet you did.
I bet you did. Right. I got a smoking deal on my home.
The market was down in 2011 in Phoenix, right?
Yeah. It just started to come. Well, no, excuse me. 2012. It just started to come back up. I bought it in 2012. It just started to come back up. I probably missed it by about 3 or 4 months. The bottom, if you look at the statistics. But I'd be hard pressed right now to find a similar house that I could afford, for the payment that I have.
Right.
So if I was to say equal payments, and once you get into a house, you start budgeting yourself. You get other things in your life. You do other things. You take vacations, whatever. You kind of get used to your budget. I'd be hard pressed to find a house of equal amenities and things like that for what I'm paying right now. I couldn't in the neighborhood that I'm at. There's no way, because values have gone up so much. So that's a tough part to kind of swallow. So to predict where you're going to be in 5 years, that's really hard to predict, because I'm only 4 years into it, and my wife's like, "Hey, you want to sell?" I'm like, "Yeah, sell, move up." I'd have to move down.
Right. Yeah,
I'd be taking a step backwards, right?
Right, because you guys have
increased
in prices.
Yeah,
in prices. 20. What do you think? What do you think it was percentage-wise since when you bought that it's increased?
Well, when I bought my house was built in 2000 or 1991, I think, and the prices at that point were 1993 prices. And now I purchased my home. I'll tell you, I purchased it for $342,000, and now it's probably worth. When I did a comp about 6 months ago, it's about worth $525.
Nice.
So that's how much in 3 years it's gone up. It's ridiculous, quite honestly. I'll take it, right? I'm not complaining. But if I were looking to buy into it now, I'd have to buy $500,000. Right. I'd have to, it's like, I don't know if I want to do that. And we're not growing property values. It's not growing as fast as it did once the market there turned from 2012-ish to today. Well, wages too, right? I mean, we've talked about that before. Wages haven't really kept up with the inflation of home prices, really, in my opinion, at least not here in Phoenix. My dollar that I earn per week or whatever, it doesn't go as far today as it did back in 2000, even with the gas prices the way they were. Right. I mean, gas prices are now, of course, but things were just cheaper. Housing's a big expense. I mean, we played that thing from Julian Castro, that audio expert, right? More and more people are paying over 33% of their household income just dedicated toward their house payment or rent payment, for that matter. Mm-hmm. So it's gotten way expensive to purchase homes in and around the country, which is a huge problem. It's a huge problem. And that's why I say, accurately predicting where you're going to be in 4 or 5 years, very, very difficult to do that. So you got to be comfortable with where you're at now, which means interviewing your realtor, interviewing your loan officer, making sure you're getting the right deal today. Yeah, I talk to people even with down payment assistance, because first-time home buyers, when you move into the house, you're going to get inundated with mail saying, "Hey, I can get you a better deal. Hey, the rate today is 1.5%. Call me today before it expires." Blah, blah. You're going to get inundated with all this, these flyers and things like that of what you should be doing. And they're very good at making you feel like you're an idiot because you're not doing it. And so then you end up using your house like a bank account, and you refinance, and you end up getting into more and more debt because you're using the equity to pay for the cost of the refinance. And it's not really helping your situation because you're not going to be in the home long enough to recoup the cost to do what you're looking to do. All right. That's a really bad short-term fix. A total bad short-term fix. All right. So we're pulling up on an hour, and we got deep into mortgage stuff, So where does the first-time home buyer start? We kind of covered the very basics. Interview real estate agents, interview mortgage brokers and bankers, and find out what their costs are, find out what kind of vibe they're giving to you, and I guess at the end of the day, you have to be able to trust them, because you need you're putting together a team that's going to help you get from point A to point B, which is out of your mom's basement or out of the apartments and into a condo or a townhouse or a single family. Yeah, absolutely. So, you make phone calls, interview people. Obviously, referrals are a good source. 90% of people go to the internet. Check people out on the internet. What are they doing? What are they saying? If you can't find a loan officer on the internet nowadays, or a realtor on the internet, not saying they're not good, but I definitely would be asking the question: why aren't you on the internet? Why don't I know more about you? Especially with millennials and younger folks who are on the internet constantly.
And that means
older realtors.
And that means looking at the reviews, looking at their True
Yeah.
and Zillow profiles, looking at their LinkedIn profiles, looking at their Yelp profiles. Find the reviews, and see if you can find it. See if you can put together a track record of reviews from from whoever it is you're checking out, the realtor or the mortgage guy.
I'll say about Yelp, I don't trust Yelp, man. I'll be honest. Yelp is I hate Yelp. I'm not on Yelp. I've never received a bad review or anything on Yelp, but I hear of tons of people who have received just ridiculous reviews from competitors who try to make them look bad, because Yelp doesn't really audit who sends those reviews in. So I don't know if I trust Yelp, but definitely look at the profile. LinkedIn is a big one, right? LinkedIn is a big one. Look how professional they are on LinkedIn. I see a lot of loan officer profiles on LinkedIn that look like they should be selling marijuana. I mean, come on, guys. You're dealing with a big deal here. Make yourself look presentable. We have a kind of a comment here about credit unions. Credit unions are great. I used to work for a credit union, Arizona State Credit Union here in Phoenix. They're great. They have some of the best programs as far as rates and things like that goes. They're not always the best at underwriting files. They're tend to be very conservative toward things. And if you fit in that box, fantastic. They're not always the best when it comes to turnaround times, unless it's a local small credit union, which most credit unions are for that matter. We have a couple big ones here. Desert Schools is a big one here in Phoenix, Arizona. They tend to not do such a good job. In fact, they farm out all their FHA loans. They only do conventional financing. All government stuff they farm out. So they don't always have the array of product line. But if you do fit into their box, credit unions are a pretty good way to go. So I would recommend a credit union for sure. If nothing else, shop the mortgage banker or whatever against the credit union to see where they're at. USAA is getting into that too. USAA, big insurance company. They have so many overlays to what they do. It's kind of ridiculous. A lot of people get frustrated with them. But I think Discover Card even does mortgages, second mortgages. Again, very, very clunky, very painful, teeth pulling kind of atmosphere when you're going through them. And that's part of the question you need to ask your loan officer. What's your process? What can I expect? That sort of thing. So, go into it knowing, because if you're on a deadline, right, Jorge, if you're on a dedeadline and you most closings here in Phoenix take 30 days, most, maybe 45 days with TRID.
Yeah, more now.
So if you are making an offer on the house and it's very competitive right now in Phoenix, if you're making an offer on a house and you want to close, you can't say, hey, I need to close in 60 days. The seller's probably going to say, take a hike. I got other offers here that are going to be at 30 days or less. And so when you're talking to credit unions and other things, you want to find out what their turnaround time is, what their process is, so that you can put the right offer forward when you're making your offer on a home.
Good, man.
Yeah, Capital One, I think, is also doing mortgages as well.
Good, man. I like it.
Haven't heard anything about Capital One.
I think.
Joe, should we?
Yeah, you know what? There's so many things here. I think you could definitely do like a part 2, because there's just so much information when it comes to mortgages and who to pick. Because like I said, even with me being in the industry, there's a lot of things I do not understand about them, other than the fact that there's definitely a few bad apples out there when it comes to mortgage guys still, and
a few. My God.
Yeah, and it does get complex. And like I'm hearing you talk, and I believe everything you're saying, but then there's just so much like, oh my God, like where do you even start?
Did I throw the 50 caliber at you?
It was a lot there, but it was good stuff. I dig it. It's like the same thing I do to you when I start talking about Facebook and stuff.
I know, right? I know, it's overwhelming. There's tons of stuff. And that's where, like you said at the very beginning, man, it's about trust.
Yeah, it is.
And having that interview with somebody, you start to build that trust up a little bit. You kind of understand people do business with people they like. I'm not going to be able to do business with everybody. I get that. But I do take my business very seriously. Hence why we do these sort of things, to put the word out there. Right. So,
yeah, man. Hey, Kenny, thanks for the comments there and stuff like that. I dig that. And thank you.
Yeah, thanks.
And thanks, Charlotte.
Here, man.
Charlotte Social.
Charlotte Social 360. And I know you have a name, Charlotte Social, but I forget it. I'm sorry. But hey, if you want to reach out, and hey, if you guys want to join the Blab, man, we have the open sea. You're more than welcome to do that. We're going to end it. We try to keep it in an hour to be respectful of everybody's time, but we do this typically every Wednesday. We talk about things. Next week, we're going to talk about what is it? Appraisals, right? Yeah, we're doing appraisals next week. So if you got questions about appraisals, because appraisals, how to get a fair appraisal. Appraisal is one of those things that's just kind of one of those things that we just accept. And the reason we're doing that, in all fairness, I forgot to hit record last time, like a knucklehead here on Blab. But so we're going to redo that. And then the next week after that, we're going to do all the top news stories in real estate. So please tell your friends, join us. If you want to join the Blab, please do so. I'm Jason Bates. You can visit my website at www.valleyofthesunrealestateshow.com.
My name is Jorge Cuevas, and you can find me at agentredefined.com.
Very cool. Very cool. All right. Thanks a lot, man. I think we'll pause the recording and then